CPI data over here on Thursday created a lot of volatility late last week in the stock market. CPI was higher than expected, gapping the markets down with expectations of a more hawkish Fed. That was on Thursday morning, but perhaps some intervention didn't actually let the markets go down too much, perhaps as we have the midterm elections coming up. On Thursday, we discussed with the members at myfinancesteacher.org a couple of likely scenarios for the stock market. By the way, for timely analysis, join us at myfinancesteacher.org. One of those two likely scenarios is a bounce into a new short-term daily cycle, although that would imply a previous daily cycle of relatively short duration of only 37 days. And as the intermediate cycle is also pretty short at only 119 days or 122 days as of today, that implies that this short-term bounce into a new daily cycle will likely be followed by a drop down into another daily cycle as well as intermediate cycle low. And that, of course, is very likely to be a lower low. That's where I would actually be interested in buying. A second scenario, as this short-term daily cycle low is still pretty short, at only 41 days as of today. So a second scenario is a continuation down, breaking some of these support zones. If you zoom out a little bit, the Thursday low was at a couple of support zones. That's from the 50% Fibonacci retracement of all of this rally since the pandemic low, and based on the support of these late 2020 highs. All of that is somewhere around 3,550-ish on the S&P 500. So S&P is very close to that. If that is broken, that might imply a waterfall decline down to the next levels at 62% Fibonacci retracement and late 2020 lows. That's somewhere around 3,200-ish again on S&P 500. That would be, of course, a pretty significant drop, implying a likely early intermediate as well as the daily cycle low. And again, in that case, if that happens, that's again where I'd be interested to buy. Right now, though, waiting on the sidelines is quite comfortable. It's been comfortable on the sidelines for a while. And looking at the optimism index, in a bear market, perhaps you would like optimism index to drop a little bit lower than usual before you get a relatively safer buying opportunity. Generally, historically, somewhere around 30 is where buying opportunities come around on the optimism index. But again, in the bear market, you would like to wait for more blood on the street. Looking at recent history, in mid this year, the previous intermediate cycle low came with a bit of a positive divergence on this optimism index. We might actually likely see something similar this time, either with a bounce into a new short-term daily cycle followed by a lower low, or perhaps a break below those support zones relatively soon. So that's what perhaps you should be looking at, but at the moment though, waiting is perhaps not a bad strategy at all. At least that's what I'm doing right now. At least that's my opinion on the general stock market. Let me know what you think on S&P 500 going into the future. I'm looking forward to see all your comments, especially in light of the triple Qs, the Nasdaq rather than S&P 500, having already lost that support zone from late 2020 highs. It's actually at the next support of late 2020 lows at the moment. Already close to somewhere around 62% Fibonacci retracement of all of that rally from the pandemic low. So is the tech industry foreshadowing what's likely to happen to the general stock market on S&P 500? That is a distinct possibility, but in either case, let me know what you think down in the comments below. Have a nice day. Bye bye.